We are firmly in a new normal. In Friday's non-farm report, it was revealed that a staggering 20.5 million jobs were lost across April, propelling the unemployment rate to 14.7%. It also caused wage growth to shoot up to 4.7%, reflecting how the job losses disproportionately impact lower earners. And yet, because that non-farm number fell short of the 22 million forecast, meaning the unemployment rate was kept from hitting the expected 16%, the Dow Jones celebrated, ending the week at its highest level since the end of April. The goalposts have well and truly shifted. We might be in unprecedented territory, but investors have acclimatized to these alarming data dumps incredibly quickly. Though there's nothing likely to be as headline grabbing as the recent non-farm numbers, the US still has a steady stream of data to deal with this week. The inflation figure is set to drop from minus 0.4% to minus 0.7% on Tuesday, while on Wednesday, PPI is expected to slip from minus 0.2% to minus 0.4%. Wednesday also sees a speech from Federal Reserve Chief Jerome Powell for the Peterson Institute of International Economics. Investors will be looking for hints as to what the central bank has got planned, especially since their sanguine response to the mass jobs losses suggests that the markets are expecting further stimulus sooner, perhaps rather than later. Thursday then sees the usual jobless claims, which could fall under 3 million this week if the recent trajectory is anything to go by. Finally, Friday will likely bring with it another terrible retail sales reading, falling from minus 8.7% to minus 11% month on month. The real market moving numbers this week, however, could well be those out of China. Friday morning should see fixed asset investment improve from minus 16.1% to minus 9.5% month on month, with industrial production swinging from minus 1.1% to plus 1.5%, and retail sales up from minus 15.8% to minus 5.9%. Given the weight investors put on any figures out of China, especially since China is, a month or two or three ahead of the West in terms of its response to the coronavirus, any signs of improvement out of the region could be a disproportionate boost to the markets compared to any negative data, say, out of the US. Speaking of China, the situation between Beijing and Washington remains sort of unclear. Donald Trump's attack on America's rival superpower, an attack designed to draw focus from his own handling of the pandemic as he gears up for the 2020 election, sparked a wave of market-wide losses recently as investors feared a flare-up in tensions mere months after a Phase 1 trade agreement between the two was finally reached. Negotiators on both sides did last week pledge support for the Phase 1 agreement, somewhat easing the market's fears. However, Trump and his supporters, like Secretary of State Mike Pompeo, aren't letting up their China attacks, going so far as to claim China created COVID-19 in a lab. On top of this, you also have a study from think tank Centre for Strategic and International Studies suggesting that China will fall way short of the purchases of US goods agreed in the Phase 1 deal, something that could well cause an eruption in badwill right at the wrong time. I think, given how things have gone in recent weeks, any further developments between the two superpowers could well dictate the direction of trading more so than the week's economic calendar, especially since there isn't anything in the week's US economic calendar that holds the same kind of heft as either the non-farm figures from last Friday or those Chinese figures expected to come in the early hours of this Friday.